also known as Diamond Dave, the founder of the highest paid part-time job in the world options trading course. And what we're going to talk about is a really, really timely story, but this is going to be really, really good information for traders who want to really understand how to be a successful trader, how to have some longevity, and they want to understand the real meat and potatoes of being a trader. So if you're a trader, you're not having the success that you desire, you're not having any kind of sustained success, and you can't really figure that out because you watched all the YouTube videos, you followed all the courses, you followed the people that you thought could help you learn what it would take to be successful, and you're still not having the success that you desire, I want you to listen to this presentation and kind of give me some feedback on whether or not I was able to open up your eyes to what may be really going on and allow you to start understanding what maybe you were missing in your trading education. And then maybe you will decide to reach out to me about the highest paid part-time job in the world. And we can really tap you into something that can really help you get to the next stage of your trading career or your trading objectives. And what we're talking about is how Credit Suisse and another Japanese bank called Nomura lost a lot of money because essentially they had a relationship with Archegos Capital Management, which had a lot of derivative positions that went south on them. And then, they had the margin call Archegos Capital, but they kind of got left holding the bag somewhat. So Credit Suisse lost around $4.7 billion. Nomura lost around $2 billion. And we saw that Goldman Sachs and Morgan Stanley came out unharmed. And it's probably because Morgan Sachs and Goldman Stanley started selling first before everybody else. So they was able to kind of escape, and then everybody else figured out what was going on. Once the cat was out of the bag, the story was out. They had to kind of sell things for what they could get to try to liquidate their positions, to try to get some of their money out of Archegos Capital. Now, this particular story illustrates a really, really important point that I teach all traders. And so if you ever taken my course, I think on the second class, one of the things that we talk about after we talk about like what an option is and give you some of the basics of an option, one of the most important things I tell you is that as a manager of capital, your job is to engage in risk management. Your job is to manage the risk associated with you trying to get a return on the capital. Why do we say that? Because you don't want to go broke trying to get rich. Okay. And so some people, their risk management perspective is, well, you should not trade at all. I don't believe that. And most of those people, like I said before, is that if you've been formally academically trained, well, then therefore you don't know how to produce traders, just like certain people don't know how to produce other scenarios because they don't have a training in that particular area. When we look at a lot of the larger investment banks that have a trading desk in which they trade in and out of positions, they know how to produce traders. Why? Because they've been producing traders for over 100 years. So therefore, they have a curriculum to produce a trader. They can understand the personality, the psychology of what's going to make somebody a good trader. But this was a space historically for elite people. And we're just seeing people now that are not called, that don't come from necessarily elite backgrounds, that are being allowed into this space. However, many of them are not given a proper education because a lot of them, they think they want to be traders, but they're not really 100% sure. But really what a lot of them really desire to do is be entertained around trading. And if the person entertains them enough around trading, they will buy a trading course, right? Because of their affinity for the entertainer. And then they often find out that what they've been taught really is not going to help move the needle for them as a trader if they really desire to be one, or they may just desire to get training entertainment. And a lot of that you see on YouTube. If you really desire to be a real trader, what I'm going to do in this video is kind of get you an understanding of why risk management is so important and how by implementing risk management into your trading activity, it can allow you to become a better trader. And if you want to learn more about how to do that, you need to reach out to me about the highest paid part-time job in the world. That's if you really want to be a successful trader and you want the benefits of being a successful trader. If you want to continue just to absorb YouTube entertainment, I'm happy with that, because if you like it, I love it. And you can keep doing what you're doing and I'm gonna keep doing what I'm doing. So let's get into it. So what I want to do is I'm gonna give you an understanding of how let's say a trading desk at an investment firm is set up, and then how risk management plays into that and why it's so important. So let's say hypothetically you got company XYZ. They have a trading desk, right? And in that trading desk trades a portfolio of particular companies. So let's say, just for this example, they're really situated around tech companies. Now they may have a parameter of, we trade tech companies that are, within a certain market cap size. We're going to keep it real general because I want you to understand the overarching point as opposed to the real specifics that aren't going to really change anything about what I'm talking about. So let's say company XYZ has a trading desk. They trade in the tech space, and they got a portfolio of companies that they trade in and out of the positions. Now, their job at this particular desk is to get a certain return over the course of a 12-month period, a calendar year. But they also have a responsibility to stay within a particular risk parameter. Now, that risk parameter overall is going to be set by the Chief Risk and Compliance Officer. So when we're looking at Credit Suisse, the Chief Risk and Compliance Officer, Laura Warner, lost her job. I believe Laura is a woman. She lost her job as a result of them losing $4.7 billion. So you're going to have an overall risk parameter for that particular firm. And then that can be broken down desk by desk. Some desks may have a higher risk parameter. Some desks may have a lower. It kind of all depends, but it has to fit within an overall risk parameter of that particular institution. So you're working at this particular desk as a trader. You got a portfolio of companies that you trade, and within that, you got a risk parameter. So now what do we talk about? The most important thing. The most important thing is managing the risk associated with your trading activity. It's not making money. Right. The most important thing is managing risk, because when risk is not managed properly and then you continue to expand your position, it can turn against you very, very fast. And you will look up and you would have lost $4.7 billion. Or you would look up like the Japanese company and you would have lost $2 billion. And it can happen relatively fast. And I mean fast, it can happen in a year or 2 years. 3 or 4 years is a short amount of time to lose $4.7 billion in. Right. That's a short amount of time to look up and you out $4.7 billion. So when I say it happens fast, I don't mean it's going to happen in 2 weeks. It can happen over the course of a few years. And you look up and we're out 4.7 billion and people are losing their job. Now, those people that lost their job, they're going to get another job. They're going to be all right because everybody knows everybody. Okay, so you want to understand that. So now what happens is that the Chief Risk and Compliance Officer in that particular office, they have multiple people working in that office. And inside that office, you'll have an individual and their job is to manage the risk associated with your portfolio. Now, they may have algorithms set up. They may have automation set up in which they're giving signals back and forth to let you know, hey, you're within this particular percentage of risk, or you're within, I don't know how they want to actually plot it out, whether it's a spectrum, whether it's a particular number, how they give you the data and how the data is presented to you about what your particular exposure to risk is. But they have some way of communicating that to you. And therefore, it's your job to follow that. Now, you may have a scenario where you have a specific amount of exposure to a particular area, and then the particular risk parameter may say, you know what, your exposure is too great. As a result, we need you to trim your position here and then also increase your position here, right? Or vice versa, right? Or they may feel like, well, you know what, this has happened in this part of the world. We've absorbed that data. We've come up with new risk parameters as a result of this new information. So now as a result, we need you to add your position here and trim your position here. And this is one of the reasons why you see what's going on in the market, right? Based on risk parameters, a lot of the institutions are trading in and out of positions all the time. They're not trading in and out of positions just because they want to make money. They're trading in and out of positions because they have a particular risk parameter or risk profile that they have to adhere to, right, as part of that particular firm. And as a result, right, they got to move in and out of positions. It's just the way the game works. So a lot of times when you wake up in the morning and you may see a company do a really, really good earnings and sell off. Why? Because in their mind, this stock price at this particular point, we don't believe it has sustainability. So it puts us in a position because of our exposure, the amount of shares that we own, because of our exposure, we believe that it's too risky to be in this particular position at this price. So what are we going to do? We will sell off, right? We'll sell off, right? A few million shares or whatever, a few 100,000 shares. We'll get out early and it will get back in at a later date when what? The prices come back down to where we think is less risky. So you got to understand something. A lot of companies understand that when a price on a stock is running, it's not a good place for them to be in because they understand it's going to come back down just as fast. So they may feel like this company is going, the share price is exploding a little bit too fast. It's time to get out before it comes back down. Another example, during COVID, you saw the cruise lines and the airlines sell off really, really hard. Why? Because nobody knew when COVID was going to be over. People saying COVID was going to last 2 years, right? People saying we're going to be locked down for 6 months. And therefore, a lot of the firms wanted to get out of anything they thought had an exposure to COVID. So what were they doing? They were selling off very, very hard, right? Now, they weren't dumping it, but they were selling off really hard. So what you saw with the cruise lines is that they just kept selling off. Like me and another member of my group, We watched the cruise line sell off for like almost a month straight. We made a lot of money on that. If you looked at the RSI, for people that like to follow the RSI from a technical indicator, the RSI was showing oversold on the daily and the weekly. Didn't matter, because the risk parameters that these particular companies was in, it justified them to continue to get out of these positions, right? We saw Warren Buffett dump airlines, right? His airline holdings during that time. They had to get out because of the risk parameters. So you got to understand is that at that particular moment, what they were getting back from risk and compliance was that it's too risky to be in these positions. We got to get out. So we got to trade out of this position. You understand me? So we all want to understand the most important goal a lot of times is risk management, not just making money. You're going to make money in the market if you know how to trade. You're going to make money. It's too much money in the market. The New York Stock Exchange has a market cap of $80 trillion. The question is, how do you maintain that? How do you keep that sustainable? How do you build off of that, right? By practicing risk management, because if you don't really practice risk management, you'll lose your money just as fast as you'll make it. You'll be up 30,000. You'll be down 25,000. You'll be up. You'll take that 5,000. You'll turn around and make another 20,000. You'll be back down 10,000. So you'll get these swings because you're not really practicing risk management, which may mean that you grow your account a lot slower, but you maintain it, which is the goal, right? So when you're working at a trading desk, the goal is not just to blow the account up. And when I say blow it up, I don't mean the goal is not to explode the account. The goal is to grow it at a really, really reasonable rate and not lose it while you're trying to grow it. You understand what I'm trying to tell you? So it's a totally different mentality that a lot of people have to now be re-educated in and be re-indoctrinated in, because the average person in American society has never been taught how to manage capital. So what we're doing at the highest paid part-time job in the world is we're doing something very radical. We're taking working class and poor people. And I don't mean poor as a derogatory term. I just mean from a relative income statement. I don't mean as a derogatory term, right? We're taking working class and poor people, right? People that have historically never would have been given the opportunity or the responsibility of managing a capital. And we're showing them, right, how to manage capital. And that's very radical, because you're supposed to at best know how to do a budget. You're not supposed to know how to do anything outside of that. And so now when you start understanding that I have to learn how to now manage capital, how do I grow capital? And yeah, you can just buy and stock it away and hold it long term, but you also can trade depending on what you think you have a psychological aptitude for. Everybody's not built to be a trader, but if you are built to be a trader, I think you should have the opportunity to be one. And I don't think you need to go to Harvard or Yale or MIT or any of these schools just to have the opportunity to be that. Okay. So you really want to understand is that managing risk is one of the most important aspects of trading and managing of capital. And we see in these particular scenarios, right, not managing the risk properly cause massive losses for these particular firms. And let me give you something else. We're going to get a little bit deeper with it. It's a really good movie that I want you to watch, right? That came out about this. It's called Margin Calls. I don't know when this came out. This came out probably like 6 or 7 years ago. A really, really good movie. And what this movie is about is similar to what we just talked about. Where there was a guy working at a particular firm. He was working on the trading desk late night, and he was looking through some data, and he realized that this particular company's exposure, I think it was mortgage-backed securities. If this thing goes the wrong way, it's going to sink the company. And then they have this drama about how they have to come in and have all these meetings. And after all the meetings, you know what they decide to do? We got to sell our position. And so what they do is that next morning, nobody really went to sleep that night. They literally had meetings all throughout the night. First thing in the morning when the market ticked off, they had told their traders. Now, trading is gambling, is this, is that. This firm had a room full of traders that worked for them. They told their traders, we're going to give you like $1 million bonus if you get us out of these positions. And there's like another $1 million bonus if everybody gets out like by 90%. So it's like $2 million for each person sitting on the scale. We got to get out of these positions, because what we talked about with Goldman Sachs and Morgan Stanley? The reason why they didn't get burnt in that particular situation with Archegos is why? Because they got out first. So what we see in this particular movie, which came out before this even happened, this guy right here in the middle told his people, we got to get out now, because if we get stuck holding this stuff, it's going to kill us. So he told his people, sell everything. And this guy, I think it's Kevin Spacey, told him, well, isn't that going to destroy our relationships in the industry? He said, man, you don't understand what's going on. This is what we're in. Our job is to leave them holding the bag, not for us to hold the bag. That's just what it is. Okay. So you got to understand is that they woke up and they traded all their positions and they took big losses by the end of the day. So if you understand the trading day, they started trading at 9:30 till 4 o'clock. I think they started off at 9:30. It was taking 93 cents on the dollar, 94 cents on the dollar. By the end of the trading day, they was taking like almost 55 to 60 cents on the dollar to get out of these positions. So they was taking massive losses, but in their mind, it was better to take a 45 to 50% loss than take 100% loss, because once everybody realized that those mortgage-backed securities that they got sold ain't worth nothing, you ain't gonna be able to get nothing for it. You won't be able to get 5 cents on the dollar for it. You understand me? So this movie is a really good example of what we saw right here. And I use one of the movie posters from this movie for Market Mondays. I just didn't include the actors because I didn't want to throw y'all off. Okay. So if you really want to understand this scenario, you can go watch this movie. Because once you understand the markets, when you watch movies like this, they make sense in a different way because you can really understand what is actually going on. And this is the same scenario. Somebody realized that, you know what, our exposure to a particular, our exposure at a particular trading desk based on our portfolio is really, really high. And even in this movie, they had the risk management guy, the compliance officer, come in and talk about, you know, I tried to tell y'all that this was a bad scenario to be in, yada, yada, yada. But they took it anyway. Why? Because they wanted to try to make money. Everybody trying to get their bonuses. And they realize that, you know, if this thing goes south on us, it's going to sink the company. So what do we do the next day? We just trade. We get out of all our positions with exactly what you saw with this. So on Sunday, when I think either Morgan Stanley or JP Morgan say, hey, we're going to sell 47 billion shares of Viacom because we're liquidating, because we got to get our money out of this situation with Archegos. We're not going to get left holding the bag. We're going to leave Archegos holding the bag, but we're not going to get left with it. That's exactly what they were doing in this movie. But I want you to understand the theme of the actual lesson to be learned from this scenario, and the lesson that need to be learned as a trader is you really have to start focusing on managing risk. The New York Stock Exchange has an $80 trillion market cap. The money's not going anywhere. It's going to be there. Once you develop the skill of trading, you start to understand how to recognize situations. You start to understand how certain companies trade based on the seasonality, based on their trading history, based on particular institutions that may be in them. You start to understand that you're going to make money in the market. You don't have to take a lot of unnecessary risks trying to get somewhere a lot faster than you think you would get it with a really methodical approach. You understand me? And so I really want to encourage you to implement risk management into your trading activity. And if you want to learn a little bit more how to do that, then reach out to me about the hardest paid part-time job in the world. But even if you don't, try to implement that into your trading activity, because I know you can benefit from it, especially long term. However, don't let people tell you that you cannot be a trader, because without traders, there is no market. So there is not even a buy and hold without traders. There is no buying and holding without trading, because what do you know the price of what you're buying and holding if it's not being traded 5 days a week, Monday through Friday? So don't let anybody tell you that you can't be a trader, but you need to deal with traders, actual traders, and traders that have taken losses and can teach you how to not take the losses that they've taken, as opposed to traders that only talk about their wins in the market, but they never take any losses. Well, that's how I know they're not a trader, because traders take losses. Because if Credit Suisse takes losses, and if Nomura takes losses, and they have rooms full of people, right, whose their only focus is to worry about these scenarios, and they take losses, of course, somebody on YouTube who does not have that amount of resources, they don't have that amount of personnel, they don't have access to information that these firms have, and these firms do have access to information that the average person does not have, okay? And they don't take any losses. You got to ask yourself what's going on. So I want to really encourage you to get information from the right people that endeavor to put you in a position to be successful, and discard information for people that really are just entertaining you, right? Just for the sake of entertainment's sakes, unless you just want to be entertained, and I'm cool with that. So if you want to know more about the highest paid part-time job in the world and how you can implement risk management into your trading style, reach out to me. Link should be in the description. If you know somebody can get value from this, share it out. Like, share, subscribe. This is David W. Williams, also known as Diamond Dave, and I'll talk to you later.